I've been receiving messages lately whether investing enthusiasts should buy Apple stock or not. Even while I'm an Apple investor myself since 2016, I've recently seen a couple of charts that are making me wonder if now is a good time to add to my holdings. It's a little bit hard to see, but the stock is down about 5%, which kind of disappoints me. It's safe to say that 1 month doesn't mean much. It's largely going to be noise. Even a 6-month decline of 5% isn't something to worry about, but it's enough to get investors worried and looking deeper. I've recently been thinking more about Apple's price to earnings ratio. I do have a concern about Apple's price to earning expansion. It was bouncing around in the 10 to 20 range for many years, but Apple is holding at over 30 at this point. I think we need to look at the first quarter of 2021 earnings report and pull out a few key facts. Despite the recent price decline, perhaps there are some obvious growth drivers and positive facts. First, the revenue seems fantastic. Apple achieved an all-time revenue record of $111.4 billion. They saw strong double-digit growth across every product category and achieved an all-time revenue record in each of their geographical segments. Second, hardware is strong. Apple hit a new high watermark for our installed base of active devices, with growth accelerating as we passed 1.65 billion devices worldwide during the December quarter. That includes iPhone growth of 17%, iPad growth of 41%, and Mac growth of 21%. While tragic in many ways, COVID-19 was a tailwind for Apple. It's clear that leadership is optimistic about future growth, with new product growth as well. The App Store is alive and well. In summary, the first quarter of 2021 earnings call made it pretty clear that AAPL had a really good quarter and the future looks bright. There's no impending collapse and there's no weasel language or dancing around poor results. Another matter of fundamental awareness is how Apple's earnings growth rate looks over several periods. 20-year growth rate is 17.5%. 15-year growth rate is 13.2%. 10-year growth rate is 13.3%. 5-year growth rate 10.6%. While past growth rates are quite useful, it's equally important to look into the future. There's not a perfect way to do this, but Apple is followed by an army of analysis. Check out their guesses. 2021 expected growth is 34%. 2022 expected growth is 5%. 2023 expected growth is 7%. 2024 expected growth is 10%. Before moving on, I want to mention that AAPL analysis haven't been entirely accurate over the last 5 to 6 years. In 2015, AAPL beat by 23%. In 2016, they missed by 18%. In 2017, they beat by 2%. In 2018, they beat by 8%. In 2019, they missed by 15%. And last year, they beat by 2%. What points out is that analysis aren't extremely dialed into Apple's earnings. I'll summarise a few things here. First, earnings growth is estimated to be about 13% over the next 3 to 5 years when we average it out. Second, if earnings only grow 13% on average and price to earnings is compressed to about 25, then Apple is only going to provide an annualized rate of return in the 3 to 4% range between now and 2024. Of course, it's entirely possible that Apple's price to earnings remains high. If it does, then Apple would continue to have a price to earnings over 30 and the total annualized rate of return would be more like 11 to 12%, with the price gain generating most of the returns over the time given AAPL's low divided yield. On the other hand, Tesla is losing market share in every major car market. For years, Tesla was the unquestioned leader in EV innovation. Its vehicles seem miles ahead of those being developed by incumbent automakers. For years, all attempts to create the Tesla killer ended in embarrassment and failure. These events led many to believe that Tesla's lead was effectively unassailable, and that upstart EV maker was destined to become a dominant player in the disreputed automotive sector. However, the world's automakers were not easily cowed. Learning from their past failures, many have invested billions of dollars into new and innovative EV platforms. After years of efforts, these investments have at last begun to pay off. Last year saw the debut of a number of next-generation EVs specifically engineered to rival Tesla's offerings. This year, we'll see several dozen more EV models come to the market. With serious competition heating up at long last, Tesla's privileged position at the top of the industry is coming under threat. Its market share is already declining in every major EV market on the planet. With its valuation predicted on long-term EV market dominance, Tesla's stock could face a painful downward re-evaluation if its competitors make significant headway in the year ahead. Let's take a look now at how Tesla is faring in the face of emerging competition in the world's three most important EV makers. Last year, since then, Tesla's share of monthly EV sales has declined from nearly 20% to less than 10% in January. With domestic rivals from NIO and XPeng ramping up sales and rolling out new models to target Tesla's principal market segments, the American EV pioneer will have to contend with even more pressure on its already dwindling Chinese market share. Tesla's entry into the Chinese market was meant to signal a bright new chapter in the company's history. Its Shanghai factory was built in record time, with the first made-in-China Model 3 sedan hitting the market in December 2019. Elon Musk, Tesla's high-profile CEO, has even opined that China is the future. Initially, Tesla enjoyed a warm welcome from Chinese consumers. Not much later, however, the public mood began to shift in a negative direction. A series of price cuts in the first half of 2020 soured many early adopters, while growing concerns about Tesla's build quality further dampened consumers' opinion of Tesla. Even officials from the China Passenger Car Authority have taken Tesla to task over quality issues. Tesla's Chinese demand issues have only intensified thanks to accelerating competition from a host of domestic rivals. While the Tesla Model 3 was the best-selling EV in China during the first half of last year, it lost the top spot during the back half. In January, Tesla managed to sell just 15,484 vehicles, despite the debut of the much ballyhooed MIC Model Y. That is a marked drop from December and November, which saw more than 23,000 sales and 21,000 sales respectively. Softer than expected sales have translated to diminishing electric vehicle market share. In January, 158,000 EVs were sold in China. Since then, Tesla's share of monthly EV sales has declined from nearly 20% to less than 10% in February. With domestic rivals from NIO to XPeng ramping up sales and rolling out new models to target Tesla's principal market segments, the American EV pioneer will have to contend with even more pressure on its already dwindling Chinese market share. The situation is even worse for Tesla in Europe. As the world's most mature EV market, Europe has long been a ready market for Tesla vehicles, but competition has at last begun to bite. In 2019, Tesla sold 109,000 vehicles in Europe, easily topping the region's EV sales charts and claiming a healthy 31% of the region's plug-in vehicle market share. 2020 was not so kind to Tesla, despite a considerable expansion of total EV sales in Europe during the year. Despite the surging EV market, Tesla managed to sell just 98,000 cars in the region all year. Nearly 1.4 million plug-in passenger cars were sold in Europe in 2020, a 137% jump from the year prior. Meanwhile, Tesla sales were down more than 10% year over year. As a result, Tesla fell to third place in the European EV market in 2020, coming in behind Volkswagen and the Renault-Nissan-Mitsubishi alliance. 2021 has started off poorly for Tesla in Europe, thanks in no small part to its having no manufacturing capacity on the continent as yet, which makes it reliant on shipping from the United States or China. Thus, January tends to be a bad month for Tesla in Europe. Even so, January 2021 was worse than usual, seeing just 1,619 sales for the month, a visible drop from the 1,977 it managed in January 2020. Tesla's weak January showing gave it a meager 3.5% of EV market share, which was only good enough for 8th place. Among all plug-in vehicles, Tesla failed to crack the top 20 according to Inside EVs. With Volkswagen now firmly established at the top of the European EV market and followed closely behind by numerous other automakers, it looks like Tesla will face an uphill battle to regain market share. The United States has always been Tesla's biggest and most important market. The company has dominated the nation's EV space for many years, fending off the challenges of numerous domestic competitors such as Ford and General Motors. However, it appears the Tesla sway over the American market may be waning at last. While Tesla has seen its stock price slip a bit high, its market capitalization is still a staggering $596.5 billion. That dwarfs the valuation of all the other automakers on the planet by wide margins. Even Volkswagen's $113.8 billion market capitalization is Lilliputian by comparison. Yet, while Tesla's investors have managed to remain largely unfazed thus far, they should find it increasingly difficult to ignore the facts. As competition intensifies and Tesla's stature with the EV universe proves to be somewhat less than that of the overwhelming colossus, its valuation is liable to come under pressure. Ultimately, the bullish investors' expectations of Tesla's supremacy evaporate in the face of undeniable competition. Tesla's high-flying share price is likely to face intensifying downward pressure. When that realization and the subsequent re-evaluation will occur, however, is a more difficult question. Tesla's share price has defied economic gravity far longer than virtually any skeptic thought possible. Thus, I would caution investors to approach this trade with great caution and patience. The information displayed on this video may not come out as expected, and this is why I always encourage people to do their own research as well before investing. But by doing research, I came to this conclusion. Before leaving, don't forget to like, subscribe, and hit the bell button for notifications on future content. Good hunting.